Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for February 2016. Now, 2016 has started off on a bit of a softer note compared to what we saw at the back of last year. What we saw in December was very strong rates, with the VLCCs earning $100,000 per day on some routes, and about $50,000 per day on the Suezmax and $40,000 on the Aframax. The rates have come off since then. They've come off pretty significantly into February, such that the Vs are now trading about $40,000 to $50,000 a day. The Suezmax are down about $30,000 a day, and the Afras are about $25,000 to $30,000 a day. But I think we should note that December rates were particularly strong, driven by a few factors. Firstly, China had record crude imports in December. China imported 7.8 million barrels per day, which was a record for them. And so that obviously drew a lot of cargoes east. It caused some delays in the Far East. And similarly in the Atlantic Basin, we also had some pretty strong demand from refiners, as well as weather delays, particularly through the Turkish Straits and the Mediterranean. Those delays have eased off coming into January, and what we've also seen in January is less strong cargo movements, and that's possibly because refining margins have come off. So last year, global refining margins averaged about $12 per barrel. We've seen in the last few weeks that has come down now to about $6 per barrel, and so I think that refineries are starting to lower their throughput a little bit. And what we're also seeing is that refining maintenance will probably be a bit stronger this spring than it was last year. With the margins being so strong last year, a lot of refiners deferred that maintenance, but they're now having to do those turnarounds and do that maintenance on the refineries, and that will mean that throughput over the next few weeks will be a little bit lower, and keep rates a bit lower than they were in the fourth quarter of last year. But like I said, I think we should bear in mind that the fourth quarter was exceptional, and the rates that we're seeing now aren't too dissimilar to what we saw a year ago. So the rates are still doing pretty well. They've just come down from the highs that we saw in December. And if we look to the next few months, once this period of refinery maintenance and Chinese New Year, once we've got through that period, we think that the fundamentals are still pretty strong for the tanker market. Oil prices are expected to remain low, at least through the first half of the year, but possibly through the whole of 2016. Global oil demand continues to grow. Most forecasting agencies are saying about 1.2 to 1.4 million barrels per day of growth. And we expect to see more cargoes coming online from places like Iran and Iraq, which will help tanker demand. What we're also seeing is because oil supply is continuing to outstrip demand, more and more oil will continue to go into inventories. In fact, in the IEA's latest report, they said that in the first quarter of this year, about 2 million barrels per day of oil will continue to go into inventories, with another 1.5 million barrels in the second quarter of the year. So that means in the first half of 2016, an estimated 370 million barrels of oil needs to go into storage. Well, in a report that the IEA sent out last month, they said there was only about 300 million barrels of storage available this year, whether it's new storage coming online in China and India or existing storage in the States. So we think there's a good chance that in certain parts of the world, storage levels are going to start bumping up against some limits there. And that'll lead to some more vessel delays, ullage delays, probably ships sitting with cargo on board, and probably some regionalized floating storage as well. The contango, the curve in oil futures, is currently at about 70 cents per barrel per month. We think if it gets to about 90 cents to $1 per barrel per month, that could really cause some traders to put some oil on ships, and then we'll see quite a few ships potentially taken offline and into floating storage, which again could boost the rates going into Q1 and Q2. So we still think that even though in the near term there might be some softness from the refining maintenance and the normal seasonality, the fundamentals suggest that 2016 is still going to be a good year, particularly through the first half. There are some potential headwinds coming in later in the year and into 2017, particularly from the fleet growth side. There is quite a large order book for VLCCs and Suezmaxes, which will come in over the next few months, but it's really back-weighted towards the end of 2016. And we should bear in mind that as the ships come in, it takes the ships a while to get into position and get their approvals and so on. So we really think that any pressure that's going to come from the supply side is going to be more of a 2017 issue than it is for 2016. So that's our update for February, and we'll talk to you again next month.